And now, our first speaker, Florida Realtors Chief Economist and head of its Industry Data and Analysis Department. He informs realtors, the media, and the public on issues and trends that impact the state's economy. Please welcome, from Orlando, Dr. Brad O'Connor.
Thank you, Jeff. Always good to be down here in Naples. What a change of venue we've had here. This place is pretty amazing. Didn't even know it was here. And we often, throughout the state, outside of your area, we think of Naples as, luxury, spacious living, and retirement maybe to a degree. And you don't think about how we have companies like this sprouting up all over Florida who are innovating and creating jobs. If you look at the jobs numbers in our state over the past couple of years, not only have we recovered from the pandemic much more rapidly than the rest of the US, but here in Florida, the kinds of jobs we're creating, if you look by sector, we're creating a lot of finance jobs, a lot of professional, scientific, and technical services jobs, a lot of great high-paying jobs that will allow people to have the American dream of home ownership here in Florida and start families and create new generations of Floridians who eventually will be buying real estate as well. So there's a lot to be optimistic about here in Florida and specifically Collier County. So thanks again for bringing me down. I am going to focus somewhat on the state in general, but I also have some slides in here on Collier County specifically. I know Cindy's going to cover the local market here in much more detail than I am a little bit later, but I will be talking about Collier County a lot too. But first, I'm going to step on Lawrence's toes and talk about the mortgage rate because you can't escape it. I'm going to let him give you a very 30,000-foot view of what's going on across the nation, but this rate is affecting every state, and there's no ignoring it. So any analysis has to include what's going on with the 30-year fixed mortgage rate, because that's the main driver of our housing market right now, driving it in the wrong direction, but it's the driver. I want to point out, I think I did this last year too, our previous low was around 3.3, 3.4%, and that was back in 2012. In 2018, we got almost nearly up to 5%, but we had that 2-year period after the pandemic started where the Fed had to keep the machine of the economy oiled and push those rates down, which resulted in what I've been referring to as our 2-year sugar high in real estate. Eventually inflation reared its ugly head. They had to deal with it. They had to reverse course and go back even higher than they were before. So it's been a painful couple of years, having two years that were a gift, only to be followed by pretty painful retraction of those low interest rates. So this year, I do want to point out that we are still rising in terms of interest rates. They are not rising at nearly the rate they were last year, but the last couple of weeks, you've probably seen headlines that the rates are closer to 7.5% on a typical 30-year fixed mortgage rate. Lawrence might have a different opinion than me, although I agree with him a lot of the time. But I still see some upside risk in terms of rates getting even higher than this, but we economists are notoriously bad at figuring out where rates are going to go. If we did, I would probably own this place instead of being talking here, right? So I see also not a whole lot of encouraging news that we're going to see rate cuts anytime soon. And a lot of how this rate is reacting in the market has to do with not so much as does the Fed decide to raise or lower, raise rates each meeting they have. That used to be important, but still important. But now what's more important is how long are they going to keep them up here? That's having a lot more to do with these long-term interest rate levels than anything else. So we just have to follow the economic data that we think the Fed are following, which they've said they're following. There's just not a lot of encouraging news as of late that they're thinking about lowering rates anytime soon. So we're kind of stuck in this position. We've got elevated home prices. In Florida, I've adjusted this for inflation, but you can see we're above the previous peak from 2005 and 6. after you adjust for inflation. Not by a lot, but by a little bit. We're kind of leveling out now. That ever since rates started going up, prices have been leveling out. But you look at the bottom chart, that's your monthly principal and interest payment on that median priced home in Florida. That's the sugar high years right there, where despite prices going up from the get-go, as soon as we could get out and sell real estate again after the pandemic started, we had about a 2-year period there where that monthly payment didn't go up very much. Once rates started going up, now you can see it hasn't quite doubled, but it's gone up close to doubling in terms of what that monthly payment is. Add on top of that, there are higher property taxes to deal with if you're not homesteaded and you can't port your assessed value over, which goes for first-time home buyers, anyone buying an investment property, anyone from out of state. So that's an issue we increasingly have to deal with. We also have to deal with higher insurance premiums on top of just the mortgage rate going up and pushing the principal and interest payment up. So now that I've thoroughly depressed everyone, let's get into the details of closed sales here in Collier County. I always start out with 2018 and 2019 so we can reminisce about what a normal market looked like. And your seasonality is like much of Southwest Florida and much of Florida in general, in that you have a strong number of closings from February through July and eases off a little bit, and then sometimes there's an uptick, usually tax related or something else, in December. And you get to 2020, and those first couple of months of the pandemic were a doozy, but those the lowering rates that the Fed brought about juiced the real estate economy before anything else. So there were still people who couldn't open their tourism-related businesses, but the realtors, we were all out there high-stepping, saying we're back by July of 2020, and we had our best second half of the year in possibly ever in some of our markets. 2021, that's when we not only have all of the people who were cooped up in their homes wishing they had a new home during the early stages of the pandemic, when we were thinking we would like more space for our children, we need that office space, or we're just plain sick of being in our house when we used to not be in it so much. That was driving a lot of the demand in the second half of 2020, but by 2021, the moratoria start to fade and rents start rising, and that makes being a landlord more attractive, and that brought in a lot of investors. So investor-fueled and still demand-fueled by first-time home buyers, the millennial generation getting into their prime home buying years, all of it worked together in 2021 to make it an outstanding year for real estate across Florida, and particularly here in Collier County. Then the rates kick in 2022, and you can see that if I'm going to compare 2022 to perhaps the pre-pandemic years we have in our chart, we start out a little bit above those pre-pandemic years in terms of the number of sales, but by the end of the year, we're facing closer to 6 or 7% interest rates, and you're seeing a number of sales flag. We're below those pre-pandemic levels of sales. Now, let's fast forward to 2023. I'm going to put the year-to-date sales over here on the right. So this is the first 8 months of each of these years, how many sales we had. And you can see we are not even quite where we were pre-pandemic. Now, Naples, you don't have to feel bad because this chart looks the same everywhere in the state, not just here. So we are below those pre-pandemic levels of sales so far this year. We are significantly below where we were last year, but remember, we're comparing a period where we've had 7% interest rates to a period where we started out with 3% interest rates at the beginning of 2022. You can see the black line and the blue line are converging as time goes on. That's just because those August of 2022 and 2023 are much more similar in the interest rate terms as January 2023 and January 2022. So this is kind of where, for the time being, we expect to continue in terms of the level of sales that we're seeing. We've taken the big punch from the rising interest rates. On the demand side, there's actually a lot of demand factors that are very positive and working in Florida's favor. It's really the interest rates are one of the only things that are working opposite the way we'd like to see things working and that are dampening demand. But we've taken the big part of that punch. Going from 3% rates up to 7% rates That's the bulk of the punch, and yet we still see housing demand. Notice that my chart doesn't show that there are 0 closed sales in any month this year. They are pretty close to pre-pandemic levels. We'd like to see it higher. We'd love to see 2021 come back, but we would need another sugar high to cause that. That wasn't going to ever be the norm, right? But that's why I like to compare to 2018 and 2019. Pretty good years in this market, and lots of the markets around the state. And we're gonna trudge along. This is just what we have to get used to for a bit. So I was talking about homebuyer demand. I still think that the other factors that influence homebuyer demand here in Florida are quite strong outside of interest rates, which again have an outsized impact. But domestic in-migration, so migration from other states to Florida. That's easing off a little bit. Last year I showed you a chart of data on that and said this would ease off because we were never going to see the level of in-migration to Florida we saw in the initial stages of the pandemic, when every time you would see data on a big COVID wave in New York, you would see a big wave of pending sales in Florida a couple months later. That level of migration wasn't sustainable, but I believe personally that going forward, Florida has a new permanently higher level of interest in moving to Florida from out of state. There's been a lot of things in our favor in that regard for years, and is why we have always been a receiver of folks from all over the country and a fast-growing state. But the factors the switches that flipped during the pandemic, there were a lot of folks who had thought about moving to Florida, and that was the last straw and really pushed them over the edge. They've always been interested in our low taxes. They've always been interested in our beautiful weather and our water and our beaches. But it is hard to move across the country. You leave networks, you leave your family, you know, maybe family members and friends that you've had and relationships you've established, or a job, or the schools that you've wanted to get your kids into, things like that. Like, it's not, so there's a lot of things you have to consider when you make a cross-country move. Now, most of us are not from here, so we all know that because we've all moved here. So seeing a lot of folks moving to Florida still, I want to point out that domestic in-migration is slowing, but it's still quite high, and I still think interest in moving to Florida has permanently changed and is much higher. We've had free advertisements in the media for the past 2 or 3 years where half the stories are about how many people are moving to Florida. And if you read, I don't know, newspapers based in New York that have opinion sections, then you'll see lots of articles about how mad they are about that. But it's been quite an experience here in Florida. And I know that Naples has seen people coming in from areas that we used to not get a whole lot of people coming from, in addition to our classic source areas like Chicago and New York, where we actually had a lot of people coming in, and then we had more. So I'll talk about that in a second. Housing still remains affordable and more spacious relative to the Northeast and the West Coast. So even though by our standards, if we've been here a while, real estate prices are as high as we've ever seen them, but in terms of what you can get for your money in Florida, if you're coming out of the West Coast or parts of the Northeast, it still feels pretty affordable compared to the market you're coming out of. So there's still a lot of investment and migration interest out of these markets, just a little bit less than we had been seeing. And that's entirely due to the same factors that are affecting housing overall, interest rates primarily. And I already talked about the solid job growth. So this number's getting a little dated, and we're going to get new census data pretty soon, as long as the government's not closed when it's supposed to come out. Florida's population increased by an estimated 416,000 residents from the midpoint of 2021 to midpoint of 2022. So this data is a little over a year old. But during that period, that was second only to Texas's increase of nearly 500,000. But remember, Texas has a lot bigger population than we do. If you work it out per day, that's 1,100 net new residents into Florida a day. In fact, we actually have about 1,000 people leave a day, but we have about 2,000 moving in. So, if you factor that in, on net, we have about 1,142 net new residents a day. It's also about a 2% increase. That's actually pretty big, higher than any other state. You'd think, well, we're Florida, we grow faster than most other states. That happens all the time. That's actually the first time Florida's led all the other states in this statistic since 1957. So overall, by the way, during that period, the US population only increased by less than half a percentage point. Immigration overall into the US was really down during the pandemic, and it's ticking up now again somewhat, but it was very low during the pandemic. So we have, the key factor in any real estate market that's going to drive it is how many people are moving in, because real estate, residential real estate is all about finding a place to live. So population growth, when strong, is going to boost your real estate markets, and that's been happening in our state. Now, if you want to drill down and you want to get competitive and you want to see how the Naples market is doing compared to your neighbors or elsewhere, I've got the list of all of the Florida metro areas here over that same time period we were just discussing, and we're ranking it by percentage growth. So remember, the state was about 1.9%. Most of our metros grew by more than that. And yours came in 10th out of the 22 metro areas at about 2.8%, so well above the overall state growth rate. You did lose out to the first place. The number of village people increased by about 7.5%. But 3% is nothing to sneeze at. You're right sandwiched in between, by just hundredths of a percentage point, you're behind Homosassa Springs and Ocala, and all these markets are doing quite well in terms of population growth. If you want to look nationally, you only drop from 10th to 16th because that's how strong Florida has been. Florida makes up more than half of the top population growth markets across the United States. So we've seen the high rate of growth in places like Boise and Vegas and Phoenix really slow down over the last year, but Florida's still going pretty strong. Now, I showed you this data last year, and I've got the updated version of it. It looks like a hurricane spaghetti model. This is monthly data on people moving to Collier County and exchanging their old state's driver's license in for a Florida license. So they track which state you come from, and they cut up your license and say, that place was terrible, you made a right decision, you moved to Florida. Here's your Florida license with a great picture of you on it. And then, so we can stack this data together. I did it monthly, and that's a mistake because it's unreadable. So I'm going to show you the 12-month average of that data, which eliminates the seasonal effects that are inherent in that data. And if you look, this is what I was just explaining. 2021, 2022, that's really when we saw the surge of in-migration to Florida really peak. It was during, COVID's still working its way out of the national system there. And over the course of the past years, rates have really increased. It's made purchasing real estate harder, let's just be honest about it, than it was in 2021 and 2022. So it's dampened some of this migration, but it's still, in most cases, higher than it was before. You can look across, even by market. This is how you can tell it's a lot, driven by the interest rates, because interest rates are national. There's no escaping them. It doesn't really matter what part of the country you're coming from. You've seen a decline, and that's what you're seeing here. But the underlying demand for moving into Florida is still quite high. So here I've highlighted some of the Rust Belt states and Jersey and Virginia. Even Virginia is actually about back to where it was. But you show some of the mid-Atlantic states like New York and Massachusetts and Pennsylvania. They're still at levels that are above the level of migration you saw. And then out west is where you see some of, they weren't a huge source market for us before the pandemic, but the number of Californians coming in tripled there for a while, and it's still well more than double what we had been seeing before. And weirdly, Minnesota has decided that they love Florida all of a sudden, and whereas much of the rest of the Midwest, this is going to show you all the states. The size of the bubble is how many people came from those markets, those states, the first 8 months of this year. And then the color, the darker blue it is, the more it dropped, is the percentage change from the first 8 months of last year. So we're comparing January through August in 2023 to the same period in 2022. And you can see that except for Minnesota, And Georgia and South Carolina, we are down. So just another way of looking at the charts I just showed you. We've dropped, New Yorkers have stopped coming in by a rate of 30% compared to last year. But let's look at the first 8 months of 2019 by comparison. So comparing the first 8 months of this year to pre-pandemic, and in the case of most states, we're still seeing a lot more movement into Florida. So, if you were expanding marketing channels out of state to some of these states, just realize that the market, the overall market, and what's being driven by interest rates has maybe dampened some of that demand, but I still think there's a lot of underlying demand out there. If you look out in the West, look how much higher we still are in terms of Californians coming in. Still 60% more Californians coming into this county than in 2019. So want to talk about some of the factors that can drive the supply side, because we have to not only worry about what's going on the demand side, but also on the supply side. And the only long-run solution we have for our inventory shortages is to build more. And I know that they're building around here, right? Somewhat to where they can. The vacant land that you can build on is getting scarce. And yet, it's crucial for this market that you build as much as you can, as soon as you can, because if you do not, then all of your vacant land will become pickleball courts. And there will be no getting rid of them. They're everywhere. I like pickleball's huge down here. Jeff is a huge pickleball fan, and he took very much offense when I said I was going to make fun of pickleball. But I was a tennis player in high school. You can't tell from the way I look now, but I injured my knee, and I had a good serve. So I look down upon pickleball. Like, you're playing with child's implements. Like, you should use a real tennis racket. And I think I'm better than that. But then again, my knee does limit me. So privately, I do sometimes think maybe I should take up pickleball. But I did stay at the hotel here last night. Have any of you been in there? When I woke up today, I had a new knee. I didn't. So I might be able to get back to playing tennis. All right, so looking at building permits, we're building less multifamily than we used to here in Collier County, but we still did have a little bit of a burst over the last couple of years. Anyone here who's involved in development and building knows that the interest rate situation isn't just challenging from the demand side, it's also challenging in terms of funding your own work, so especially if you've got more short-term loans involved. So that's been hurting a little bit. We've also seen a pullback in single family, but overall conditions I think are still pretty good for builders. They're still pretty optimistic, and they have that advantage of being able to buy down your rate a little bit, which on the existing side we don't have that so much. So if you total both of those things together and you just look at your overall units, you're building more units over the last couple of years, but we still have a way to go to get back to the level we need to, where we can really harness the inventory problem. And this isn't just your problem, this is everywhere in the US really, but also a fairly big problem in Florida. One exception, I spoke in Sarasota a couple of weeks ago, looked at their similar data, and they are building as much as they did in 2008 and 9. So there are a couple markets there that are not too far away from here that are, because of land use challenges, and depending on your geography, that's more doable. But by and large, it's just that's how we get it. That's how we get the supply we eventually are going to need. If you're worried about the state of the housing market in terms of prices, and I know a lot of your clients are, we have a lot of people sitting out now who are waiting for a price crash. You just look on any social media, and half of social media now is composed of people who are telling us that the housing market is going to crash in a day or two. We've already taken the big punch. They don't realize it, but it's in terms of sales that we've really been hit, and listings, and not in prices this time. Prices are going to remain where they're at as long as simple economics holds. It's always been about the number of buyers compared to the number of sellers. If the number of active sellers is, and the ratio to the number of buyers is high, there's a lot of sellers and few buyers, then you have price declines. or people pull their homes off the market. If you have a lot of buyers compared to a lot of sellers, all of you learned this in 2021. If you didn't know it already, there's bidding wars. So that's how the prices are determined in most markets, and the housing market is not really any different than that. So we've already taken a big hit to demand from higher mortgage rates. Another potential source of lower demand from where we're at now is maybe a bad recession, but the economic data aren't really indicating right now that we're anywhere close to anything like that. So where we have to get that ratio to change is to add a lot of sellers. And so people have speculated. There's a term Airbnb bust, that so many Airbnbs are not going to fetch what their investors thought they would, and they're all going to sell at the exact same time. There has been an uptick in home flipping. There's no denying that, but it's not quite nearly what we saw in 2004, 5, and 6. And yet there's not enough potential inventory there to really do damage. But what you're gonna need is somehow to get a lot of homes on the market at the same time. That's gonna be a challenge. You can look at our delinquency rate here in Florida in terms of mortgages. So obviously it was up near 18% in 2010. That's crazy. About a fifth of our mortgages hadn't been paid in 90 days or more. And then we had Hurricane Irma. Hurricane Irma put a lot of people temporarily out of work or otherwise made it difficult to make their payments. You don't see the foreclosure rate, the orange line, react at all to that, whereas the foreclosure rate skyrocketed in the previous cycle where we had delinquencies rise so much. And that's because banks learned that in a judicial foreclosure state, it's probably not very efficient to foreclose everybody. And why don't we instead work out loan terms and figure out how to keep you in your home, and everybody wins. And that's how they handled that. Then we get to the same situation. This blue line, by the way, is including everyone who's in forbearance in Florida. So the people who used all the forbearance programs during the pandemic, which is what I have highlighted now, they ended up doing pretty well on whole, and our foreclosure rate didn't budge. So now the only way we get into a situation where we're going to have to see a lot of potential foreclosures or delinquencies is that something's going to have to happen that's going to cause a lot of people to have to list or ditch their home at the same time. And what people keep pointing to is, maybe they won't be able to pay their mortgage anymore. Well, we don't have, first of all, if you look at the credit data on homeowner credit across the country, we have some of the healthiest homeowners financially we've ever had. And not only that, but no one is using subprime lending, and everybody has fixed rate loans. There are very few people with an adjustable rate mortgage right now. It's got to be like 99% of the US mortgage holders have a fixed rate loan, and that is so key, because imagine where we would be right now if we had a quarter of our homes financed with adjustable rate mortgages, and then the Fed did what it just did. Then you would be talking about foreclosures, right? But now, no, we're not. So I would point you back, the last time we had a quote unquote normal recession, which is if we are going to have a recession, I would characterize it likely as a normal recession, which does not include the pandemic and does not include the great financial crisis, since typically your entire banking system doesn't melt down at the same time when you have a recession. So going back to the dot-com recession, that's the area I've highlighted there. Foreclosures did go up, but they went up from like 1% to 1.3%. You'll see more foreclosures if people have financial distress. But to the extent that people think it's going to capsize the national housing market or the Florida housing market, I don't see that. Here, just to show you in Florida, loan structure. So this is mortgage application data by month. Which percent of loans were 30-year fixed rate, which percent were 15-year fixed rate loans, or some kind of adjustable rate mortgage. And as rates went up, you did see a little bit fewer 30-year fixed rate originations or applications for home purchases. And to make up for that, that little squiggle on the bottom, the blue line, those are hybrid ARMs that eventually will term out, but they're going to be fixed for the next few years. So no immediate danger from that regard. If you want to look at mortgage applications for non-primary home purposes or purchases, so we're now thinking about investors and how they might flood supply with the homes they've invested in. You're seeing a little bit less investment activity in terms of mortgage applications, so they're not using financing nearly as much anymore. They're back to pre-pandemic levels there. Cash sales as a percent of closed sales, sometimes also a proxy for investor activity, but also for luxury market activity and retiree activity. But you can see there, that remains a little bit elevated. And why wouldn't it? Because of the high rates, we're not going to see that many finance sales compared to what we were seeing before. So where else do we get a bunch of new listings to flood the market? Well, we could have it come from the existing side. The builders aren't going to be building enough homes to capsize the housing market. What about just existing homeowners? Well, here's 2018 through 2019. There's your typical Collier County seasonal pattern, which does look a little different than other parts of the state because of your little bump in October and November. There's 2020. Remember 2020 when we were complaining about how all the listings disappeared? Well, actually, we were getting more listings from May until the end of the year than we had in many years. The reason why it didn't feel like it is because they would sell in 3 seconds. And so when you actually checked the inventory, it was really low because you're looking at what's on the market right now, nothing. We were getting more listings than normal. It's just that they were disappearing so fast you never got to see them. So just comparing there. Looking at 2021, same kind of story, especially down here. Most months of that year, you had more new listings than you ever did. Some of that moved forward from where it would have been in a normal market, because you can see there at the tail end of 2021, you were actually lower than normal. So a lot of your listing activity just shifted earlier in the year. Same pattern in 2022. So we had 3 straight years during the pandemic where you had a fairly large abundance of listings for much of the year, but selling like hotcakes, they weren't showing up in inventory. Well, now look at 2023. 2023, it feels like there's not very many listings relative to the last 2 or 3 years because there aren't as many listings as there were the last 2 or 3 years. But there are, especially during that March through August time period. You've been tracking right along with the pre-pandemic level of new listings. So we're getting new listings. It's really hard to communicate the idea of mortgage rate lock-in, but all of you have heard that, right? Mortgage rate lock-in being that potential sellers don't feel like selling right now because they'd have to buy another home at a much higher interest rate. They probably couldn't even afford their own home right now if they had to finance at today's rates. So they're locked in. It's hard for the media and for people like me to communicate that without making it sound like that's affecting every single person, but look how many new listings you have. So it's not as though the number of new listings have gone to 0. They're still out there. Life still happens. There's still marriages and divorces and empty nests and all of that stuff that people account for. And there are investors who are also moving some of their properties as well. But you're getting about as many listings as you used to before the pandemic right now. You're lucky in that respect because other markets in the state do see a significantly lower level of listings than they had in even 2018 and 2019. If we look at inventory, I broke it down by property type here, but your 2 property types hug each other pretty closely on this chart. But if you just look at the number of active listings at the end of every month going back to 2008, you can see that we had a period where inventory was rising when interest rates were rising, but now that interest rates have slowed in their growth, your inventory has also slowed down in terms of its growth. You can also look at this in month supply of inventory terms. You like to talk about a 5 to 6 month supply being the standard for a balanced market. So if you're below 5 month supply, then you're near you're in a seller's market. We're still in a seller's market here. I know I have to wrap up here in a sec. So just want to point out that if you're looking for price declines, then you're going to have to see that month supply way up there like it was in 2009. Your median sale price has leveled out, but it's still, let's look at this, 88% higher than it was pre-pandemic. Okay, so it's not growing much over the past year, but you're way up there. As a result, dollar volume, sales might be down at pre-pandemic levels, but prices are so much higher that the amount of dollar volume moving through this market right now is still quite astounding. So far through August, you've done $7.7 billion worth of sales in Collier County, and that dwarfs what we had in 2019, which was only about $5 billion. So you're still pretty good shape there. That's something to be a little bit optimistic about. I'll leave it there. It's time for Lawrence, and I'm anxious to see what he's going to say too. So thanks for having me, and I appreciate being here.